During this video, I'm going to discuss tax relief on pension contributions, and as a high earner, how it can be extremely tax efficient to make pension contributions. So firstly, we need to understand the scale of the problem. So I'm going to discuss here is an article here by the Office of Budget Responsibility, and it talks about the impact of frozen or reduced personal tax thresholds, and it also looks at the high rate tax threshold. And there's a kind of this bullet point here, I think, just to summarise it quite well. So it talks about in the budget back in 2021, Chancellor at the time, Sunak, who's now Prime Minister, announced that the personal allowance and the high rate thresholds (HRT) of income tax would be frozen at 21-22 levels for the 4 years up to including 25-26. And subsequently, in the autumn statement, Chancellor Hunt then extended the freeze by a further 2 years into 27-28. So basically, the high rate tax thresholds are going to remain as they are up until 27-28 as a minimum. So that's going to mean that basically, during that time, even people who've been working in the public sector have received pay increases, and so it means more and more people are being pushed into this high rate tax threshold, and they're paying high rate tax. We then got an article from the Institute of Fiscal Studies, which talks about the title is "A Deepening Freeze: More adults than ever are paying high rate tax." It's quite interesting. It talks about just how many people, just the scale of the problem in terms of how many people have historically paid high rate tax, how many people are now, and how many plan to by the end of the period where the thresholds are frozen for. And the key findings, the first paragraph is really useful. So it talks about in between 91 to 92, only 3.5% of the adults in the UK paid 40% high rate tax. By the current tax year, 11% were paying high rates, and that figure is set to increase to 14% by 27-28. That's a result of the freezes. So you can see more and more people are being squeezed and having to pay high rate tax. So the government's taking more and more tax receipts from these people as more and more people are pushed into above and beyond the high rate threshold due to their wages increasing over time. And the last thing I'm going to talk about then is what can you do about it. So if you come under this category of people who, as your wages are increasing, you're moving towards becoming a high rate taxpayer, or maybe you've already been paying high rate tax for some time, there's one significant thing you can do to kind of get some of that money back from the government, and that is by making tax efficient pension contributions. And so if you were to go out tomorrow and set up for example, a self-invested personal pension or a SIP, what you can do is you can make pension contributions into this, and it's highly tax efficient to do so, and you'll actually get some of the money back that you're paying the government in high rate tax. So once you've set up your SIP, there's a number of different providers. I won't go into all of them here. For example, Hargreaves Lansdown is one. You go and set up your SIP, and that's going to enable you to invest in a wide selection of funds, or in individual shares, or in fixed income securities such as bonds. So you're going to invest some of your money into that SIP, and then what's going to happen is the government is going to pay in 20% tax relief into that account for you. So they're actually going to top up your contributions into the pension. So yeah, you pay in some money, the government's going to top it up by a further 20%, which you can then use that money to buy further shares or bonds or whatever it is you're investing in. So imagine that the government is basically buying shares on your behalf almost. You're obviously deciding how to invest the money. And that's great. And for basic rate taxpayers, kind of that's the end of the kind of advantages they get from a tax perspective. However, if you're a high rate taxpayer, here's where the real trick is. So you've got your 20% tax relief at source, you've invested that into buying more shares. There's an additional bonus the government's going to give you. So because you're a high rate taxpayer, you don't just pay the 20% tax, you also have an additional 20% tax to make you up to the high rate tax bracket. So what's going to happen is, as you go to do your tax return at the end of the year, you're going to declare your pension contributions in your tax return, and that's going to mean you get a further 20% tax relief. So basically, your tax bill will be deducted by the additional 20%, meaning that you're going to pay less tax. So not only is the government therefore helping you buy more shares and bonds through your pension, which is great, but then if you're a high rate taxpayer, they're also going to give you the extra 20% back at the end of the tax year when you go to do your self-assessment. So here you can see how pensions can be highly tax efficient. And so it's really, really useful to have a think about it. If you're a high earner, you're set to or breach the high rate tax threshold in the near term, or maybe you have been for some time, then you should really consider making pension contributions, because you're going to get some of that money back from the government. They're going to top up your pension by the 20% tax relief at source, and then they're going to, if you're a high rate taxpayer, they're going to give you a further 20% bonus when you come to complete your self-assessment tax return. Anyway, hope you found that video useful. If you did, please like and comment, and also subscribe to my channel for more content.